So, Francine, it's summer party season in London, right?
It is, but there's only one party in town if you're a city of London grandee that you want to be at.
That's right. It's not the Serpentine Party. It's not the Spectator Party. It's not even the Bloomberg Party, right? What is it? It's the Mansion House annual dinner that happens just over the road from Bloomberg HQ.
Yeah, so it used to be black ties, in fact, white ties, and now they're dressing down. Our very own city editor, Catherine Griffiths, was there.
Hi, Catherine.
Hi. Was it fun?
It was really the most fun you could possibly hope to have on a Monday evening. Yes, hot, long, absolutely stuffed to the gills in the Egyptian hall. The press all kettled in one area during the dinner, so we kind of feverishly got to talk to each other. But crucially, before and after, we got to kind of madly work the room to try and, catch up with all those execs in the Mansion House.
Catherine, who was there in the room? So, Mansion House is the official residence of the Lord Mayor. Is it more private equity? Was it pension funds? Was it a bit of everyone?
It was a bit of everyone. The chief execs and chairmen and women of all the big financial services companies are the absolute mainstay. Some senior lawyers, accountants, the likes of people who come from professional services firms. But it is, whether we believe grandees are kind of an outdated concept, but it is an absolute shed ton of grandees in there. Especially given the subject matter, there was a move to try and have people who do represent smaller, faster growing sectors, fintechs, definitely, VCs, but overwhelmingly the vibe is the big established companies. But, in a sense, that was sort of appropriate last night because supposedly they're going to kind of lead this revolution.
What were the takeaways in terms of the policy? I mean, it's always an occasion where the Chancellor, the Governor of the Bank of England tend to give the city a bit of direction in terms of the economy and what their latest package of policies might be. What did we find out last night?
What we found out really was that Jeremy Hunt, the Chancellor, doing his Mansion House for the first time, some might say potentially the last time, we don't know, wanted to be quite ambitious. He laid out a big programme of change for the pensions industry, and in slightly sort of spectacular style, they decided to have a sort of live signing event at the dinner where the chief execs of 9 big insurers, pension companies, signed this document they were calling the Mansion House Compact to invest really quite a lot of money, 5% of their defined contribution pension funds, into growth assets. That was the big takeaway. And it's depends. If you're an optimist, it could be a real turning point that we might look back on 10 years down the line and say this was a good moment, or it might be a bit of a fizzle.
So some heralded it as a new era in modern international finance, and others were really skeptic about it. Where are you on this?
I think it really is quite an important move. It's undoubtedly the case that we've seen a sort of a huge de-investment in equities in the UK. And, the UK pension schemes used to be the absolute mainstay of investment in the FTSE 100, for example. And that's really fallen. And then you look also at the world of VCs, fast-growing companies. It is a fact that the UK's 10 biggest companies were not created anytime recently in the last couple of decades. So if we want the UK to be a big, thriving international centre in the future, we most definitely need to do something about it.
We get criticised a little bit on this podcast by readers for being a bit downbeat on the prospects for the City of London. What was the mood like amongst all the assembled great and the good of the city? Are people optimistic about the future?
Yes, the Chancellor talked about declinists, which I thought was a funny word.
We're not declinists, right?
We are just absolute rah-rah people. I think the mood was quite good, actually. I think people felt there's been a lot of kind of wrangling in advance of the Mansion House about these pension reforms. There are people with quite different sort of interests, and undoubtedly behind the scenes, it's actually one thing that struck me as quite amusing is in the room, people are all quite polite to each other, but full well from having spoken to them individually that they're quite cross with each other in many ways. So that's one amusing aspect of it. But I think they felt quite pleased, actually, that this sort of compact agreement, such as it is, has come into reality. And I think they felt like they'd done quite well.
Catherine, thank you so much.
Thank you, Catherine.
I'm Francine Lacqua.
And I'm David Merritt.
And this is Bloomberg's podcast connecting you to the conversations at the heart of the City of London.
And this week, we speak with Adam Posen, the president of the Peterson Institute for International Economics and formerly a voting external member of the Monetary Policy Committee of the Bank of England.
So Dave and I read the same article, and it really caught our eye. The headline, is it time for the UK to think like an emerging market?
Yes, ouch, from Adam Posen. So we've really felt like we had to unpack his arguments there and work out what the future might hold for this economy.
Yeah, so we talk central banking, productivity, inflation, and of course what it all means for the BOE.
So an emerging market, right? Is that how far we've sunk here in London?
I realize it's sort of a epithet warning flag, but I was trying to make a slightly different point, David, which is that the macro regime has sunk to some degree. When you have 5 prime ministers in 7 years, including Trussonomics and the cabbage, and you have basically less anchoring of inflation expectations, there's a feedback loop that when you make an error or when you're behind, it's bigger than it is if you're the US or the EU or Japan. And so it's that sense that I mean, the UK is an emerging market. And so that's why you have to think in terms of structural programs at the same time as macro. You can't just sort of let things go the way you can if you're a big, fat, dumb, happy economy like the US.
But Adam, this is the point, right? So that you say the UK, unlike the largest economies, has little room for policy error, fewer good choices, and more negative shocks.
Right. I regret to say it, but I think that's the accurate statement. That we saw this with Truss, right? So when Truss and Kwarteng did their irresponsible macro policies in terms of fiscal expansion, the long end of the gilts shot right up. In the US, we had the crazy debt ceiling negotiations and the markets barely moved. So that's an example, very visible example of how you have less room for error in the UK, Francine.
I think the last time we spoke, Adam, it was in the aftermath of the Truss implosion. And we talked then, I think, about the damage done to the UK's credibility into markets and whether or not there was going to be long-term scarring. We're about 9 months later now. Do you think that damage that was done last autumn has been permanent, or has some sense of normality returned in terms of how Britain is perceived, particularly by investors around the world?
I think there was an overshoot of relief in the immediate aftermath, and normality kicked in a little too much. And now we're back to some persistent penalty. Others have called it the moron premium. I wouldn't go that far. That's with the exception of the Truss-Kwarteng policies, that's not deserved. But the idea that there is a risk premium in there, that sterling, may have recovered some recently, but compared, medium term to euro and dollar, it's much weaker. The long rate has gone back up to where it was basically under the Truss-Kwarteng threat. So, yeah, I think there's a persistent scar there. It's good. And unless you change the productivity realities, it's going to remain.
Just to play devil's advocate on that a little bit, Adam, I mean, as you said, sterling's been a pretty strong performer this year, one of the strongest globally. And when you look at interest rates, they've shot up all around the world, haven't they? Is it fair to say Britain's still a bit of an outlier on that? We've seen strong job numbers out of the United States, which has sent bonds tumbling again. So is it really just a British problem, this? Or is it really the bigger global picture about inflation being stickier than central banks everywhere want?
I think it's absolutely fair to say I shouldn't overstate it, and there are global factors at work here. But it's very different when you have rates going up for the US because, oh my God, the economy is stronger than we thought it was, versus rates staying up in the UK or going up further because, oh my God, we don't have as good control of inflation as we thought. And so the key sort of comparative chart to look at is core inflation or trend inflation. And as you've discussed on your program previously, there are many ways to measure that. But anything that isn't just noisy headline inflation, UK core keeps going up, US and ECB or Euro area inflation have peaked and are coming down, or at least moving sideways in the US. So I think there is a meaningful difference there. I think the other point is, again, yeah, there hasn't been flight and I believe I said this in my piece, it's not, UK is not Greece circa 15 years ago, right? There's no imminent capital flight, but there is, I think, more volatility and a little bit more of a risk premium there. And sterling may have appreciated some, but it's not out of the range it's been in since Brexit.
Is Brexit to partly blame because of this, or is it the idea that there was an inflation shock that could come down as quickly as it came up? Like, what are we actually left with in terms of the economy right now? It feels like it's harder to set monetary policy because the economy is running hot much more in terms of inflation.
Yeah, I think it's difficult, Francine, no question. But again, it's you have to go one level beyond into sort of what's driving it. And in the UK, to me, it's the worst of both worlds, right? So in the Euro area, you had these huge energy shocks. And in the UK, they got transmitted and amplified by the peculiarities of the UK natural gas system. So they had the same, but worse. And in labor markets, there's been shortages and mismatch, not having the right people for the jobs needed, which is similar to the US, but again, worse. In both cases, I don't think Brexit was the direct cause, but Brexit was a contributor and an amplifier. You didn't have as flexible movement in or out of low-wage workers for certain kinds of jobs, or medical workers in the UK, until you finally started getting in some higher-end Africans. And you didn't have as much access to the EU's kind of resilience in adapting to the energy. So again, it's not that Brexit causes every problem, but pretty much every economic problem is made worse by Brexit in the UK.
The government have targets to halve inflation this year. Are they going to meet that? What can Jeremy Hunt do, or what should he be doing to get the economy back on track?
As I tried to outline in my FT piece, they have to reallocate who's suffering. They need to pay more to the NHS and some other public sector workers, and tax more some of the people in the city, despite the audience of your podcast. They need to, as the latest data just came out, there's a collapse in residential construction. If anything, UK has too little housing supply, so they can compensate for that by liberalizing the planning and what in the US we call zoning rules about allowing for more residential construction. They can deal with some of the problems in the labor market. One of the big ones in the UK that I've learned about from labor market experts in the UK, is that there's this weird benefits cliff, that you're actually better off being in disability than being in unemployment. There's all kinds of weird disincentives there. You can fix those things. Basically, it's about shifting the composition of growth, or the composition of fiscal policy, in a more pro-growth direction. And what Truss and Courting did was they were trying to do it solely through tax cuts, and that was simply wrong. You have to do it in this more targeted way, this more redistributive way. And I think in terms of inflation, beyond backing the Bank of England, which I know we'll discuss, you have to think in terms of a multi-year settlement on wages. So get out ahead, give the NHS and the other relevant public sector workers a significant wage increase this year and next year, but not quite keeping up with inflation, so they have skin in the game, and lock in that they're not going to get on a further wage increase the year or two after that. So you sort of set a path for the economy.
Should the government protect mortgage holders?
Definitely not. So, in the UK, as in the US and a lot of other places, but especially UK and the US, there's this whole obsession with home ownership, even though the actual percentage of people owning homes is lower than some other high-income economies. And in the UK in particular, there's the notion of the property ladder, that the young people can't get on the property ladder. I have some sympathy for that, but there's this huge bias of what the British would call whinging, that property owners get all the upside when property prices go up or interest rates go down, or the two together, but then they're supposed to be bailed out when things go the other way. And that's ridiculous. It's a huge moral hazard. And it's also completely regressive because this is the people who already own property but haven't yet paid off their mortgages. So basically, what you're doing is you're bailing out prime age earners who have property, who have wealth, who are the best positioned to ride out their share of the adjustment in the UK economy, whereas older people who already paid off their mortgages, younger people who haven't yet got house ownership, for that matter, the 30+% of people in the UK who are in social housing or renting or just simply not in position to do this, why should they pay for those better off people's bailout? It also completely distorts markets and puffs up real estate prices. I just don't understand it. When I was leaving the Bank of England, or late in my term at the Bank of England, there was a program that the government at the time and the governor of the bank pushed through about helping to buy, which was nuts. I mean, it was a huge handout to the privileged for no good economic effect. So no.
But Adam, I was always told that actually when you look at mortgages, first, the longer term mortgages are no longer than 5 years. So unlike France or even Italy, where you can have a fixed interest rate on a mortgage for 30 years, this could be extremely ugly. So you could have a credit crunch event because essentially every 12 to 18 months, a third of the mortgages come up for refinancing. And when you go to 0.5% interest rates to 5.5%, even 6% interest rates, you could actually put the economy completely off track.
Well, again, there's always things that can throw the economy completely off track. So, you can have a doubling of the oil price and the natural gas price, and that throws the economy completely off track. And there's always a question, do you try to help directly the people affected by a given economic shock, or do you try to help the economy in general? And I would argue, particularly in the housing market, it goes the other way, that the same people who were paying or getting mortgages at 0.5% were benefiting that whole time. And so they have to get the other side of it. Also, in part because by owning, they get the speculative benefits of owning a house. Part of the reason it's much cheaper to rent than to own in the UK is because everybody's playing off of capital gain. If you have the upside of capital gains, you're entitled to have capital losses. I mean, let's be clear. If mortgage companies, were advertising on TV, grab your 0.5% mortgage right now, and there was deceptive practices telling people not to worry about interest rates ever going up, let's prosecute the mortgage companies, the lenders that did that. But if it's just people with money decided, oh no, I can assume and interest rates will never go up, that's on them.
I mean, we're seeing house prices falling now, and there's a big debate about how far that might go. It sounds like you're saying that is potentially a healthy thing in some respects, and perhaps the bank wanted that to happen to some degree. And Bloomberg Economics are now forecasting that Britain will actually go into recession later this year. And again, there's an argument that the Bank of England need to provoke a recession to bring inflation finally under control. Do you think Britain is headed for a kind of engineered recession by the bank? And is that a good thing?
I think Britain is headed for a recession, but the bank is the proximate cause reacting to other things, not the bank is like, oh boy, let's have a recession. I mean, ultimately, David, something has to give. If you've got lousy productivity growth, significantly above target inflation, tight labor markets, and corporate earnings, stable to positive, you can't keep supporting it because the wage growth has to come either from corporate earnings or from productivity growth. Corporate earnings either have to come from squeezing wages or from productivity growth. Productivity growth ain't going anywhere. So something's got to give. And so then you could decide, well, let's let inflation keep going for a long time. And that would be obviously a choice a democracy could make, but then I'd like them to actually admit it and raise the inflation target. And then you also are risking that inflation gains momentum and persistence as you let it continue. So ultimately, something's got to give. And in this situation, since the inflation target is not changed, the Bank of England's responsibility is to get things back in line. If they can get away without a recession, great. But that's sort of the point of the comparison with the US, that the US, for all its problems, I think my forecast is a little gloomier than some people, but I don't think there's going to be more than a very mild or a growth recession, meaning positive growth, but below trend. And some people think we are going to get the immaculate disinflation of inflation coming down without any rise in unemployment or large rise in unemployment. But in the UK, that just doesn't seem to be in the offing. So I don't think the Bank of England has a choice.
But do you think, Adam, the Bank of England has done enough? And how much more, if not, do they have to tighten by?
Well, my problem with the Bank of England so far has been insufficient tightening as opposed to too much. And I don't like shooting at former colleagues and backseat driving when things are tough. But, I and some others were out there pretty publicly by year end of 2021 saying, hey, this isn't just transitory inflation. We pointed this out in the US as well earlier, because it was more of an early problem in the US. And Bank of England, probably the general macro credibility is less post-Brexit, post all the political turmoil. And this is before trust. And so to me, I kept saying it made no sense that the Bank of England kept projecting a lower terminal rate than the Fed or the ECB in real terms, which made no sense to me at all, because the UK is a smaller country with a somewhat less stable regime and more energy problems and labor problems. But B, the Bank of England leadership kept publicly saying every time they raised rates, well, maybe this is enough, maybe it's not, but probably it's enough. We're not going to have to do more. I mean, that was the kind of rhetoric you kept getting. Whereas to their credit, once the ECB and the Fed started hiking, they said, we're going to be hiking for a while. So I think both in terms of actual pace of policy and substantive communication, the bank got it wrong repeatedly throughout 2022 into 2023.
So where do you see the rate settling at? The markets today, as we record this, are baking in 6.5% now.
That's around the level that I have been saying for the last year that we're going to have to get to, that they had to get well above 6. So 6.5. And if anything, the fact that the inflation's proving more persistent may mean they'll have to go higher. One of the investment banks I know published something saying maybe 7%. I wouldn't rule that out. I mean, I think 6.5 to 7 is probably about where they are. And they can start, when they get there, then they can start saying, well, we're not sure, is this enough? But until then, unlike what they said with even their last jump in rates, stop saying, oh, we think this is enough. No, admit you have a tightening bias, or at least learn you should have a tightening bias and go from there.
Adam, you know how the Bank of England works more than most people. How is it possible for them to have got those forecasts so wrong? What level of the bank should we point the finger of blame?
One of the great things about the Bank of England, I believe, and was good for me, and I think served the UK well in the crisis, was that the MPC has more open debate than most other central banks. And that's not just you have 4 so-called external members who vote, but just the general culture, as has been remarked on. The governor, in theory, at least could lose a vote and not have to resign. So I think there's room for more debate at the bank, and we've seen some of that. I think rather than talk about who did it, I would say there's been an intellectual problem. I'd say there's been a disbelief in the idea that the UK suffered anything from Brexit and recent political turmoil that affected credibility. And the excessive focus on the narrow definition of credibility as the long bond rate or the 5-year forward on gilts, I think is too narrow and was self-deluding. And I think that there was too much belief in the bank's general equilibrium modeling that the declines in real income would automatically lead to declines in nominal growth. And that is true under some circumstances, but their models built that in. And I and some other former MPC members were pointing that out a year or more ago, that was a big error. And I think they've only backed off that now.
But Adam, isn't this part of the problem that actually the way the Bank of England functions? So first of all, they have to try and forecast how much of the tightening they've done so far has an impact on the economy. Sure, they're data dependent, but also because it's a voting system, there's 7 of them. if the Bank of England governor says something, it's not certain that it gets voted in at the last quarter. So it's also very difficult to kind of guide forward the markets on what they'll do next.
I mean, I generally don't care that much about guiding forward the markets. We should remember that forward guidance was named and created in the global financial crisis as something you did when you were desperate because you were near the zero lower bound or the effective lower bound and you were worried QE wasn't working enough. And so you had to do something. And so forward guidance was always meant as a desperation supplementary tool. And instead, it's become this thing, well, we have to guide the markets. Well, eventually, the old saying about don't fight the Fed wins, same is true for Bank of England. If they decide rates are going to 6.5 or 7, whether the markets believe them or not is a secondary matter about how long it takes to have the effect they want, but they get there. The effect gets there. So the 9 members of the committee, this is what they're paid for. I mean, this is the job. It's not an easy job, but that's what the job is. So I have sympathy for them in the sense that inherently it's a big public responsibility. You're out there and you're accountable. That's another good thing about the Bank of England is that the individual votes and views are accountable. But this is the job, is to make those calls.
Let's imagine we hit 7% then in the UK. Bit of crystal ball gazing. What breaks in Britain's economy? What does Britain look like with 7% interest rates? Is unemployment shooting up? Are we going to see corporate failures? Are we going to see a credit crash? I mean, what is going to be the fallout with rates that high?
I mean, I think it looks like the kinds of tightening cycles we used to have in the 80s and early 90s, which means unemployment does rise quite a bit, unfortunately, but, started from a very low level. So you're looking at 1.5 to 2 percentage point rise in the unemployment rate. You're looking at negative growth that's meaningfully negative, meaning averaging below minus 0.5 real for a few quarters. You're looking at definitely some business failures. You're looking at almost certainly, as we're already starting to see, a major correction in housing prices and in housing production, which again is part of the reason my proposed program is you offset some of that by doing a structural reform on real estate supply, that residential construction supply that you should do anyway. Similarly, in the short term, you'll have some amounts of excess labor, but the bigger problem again is going to be mismatch. And so you want to do things to improve labor supply, given the large number of people in the UK labor force who seem to have been hit by long COVID or insufficient access to health services during COVID and are having ongoing health effects. We want to take advantage of this period. That's what I really mean about a stabilization plan. You want to take advantage of the macro turmoil to combine a number of structural improvements.
But Adam, and I know you don't care much. I don't know if I should put it like that, if you don't care much about the markets, but it shouldn't be the Bank of England's main focus. But are we now in a regime of higher real rates, real neutral rates across the developed world? I think Megan Green, the newest MPC member, suggested it, and also Bank of Canada.
Well, that's a huge issue, Francine. You're absolutely right. So at the start of this year, 6 months ago, I was in the camp saying, no, long-term rates, the fundamental drivers, demographics, bad productivity growth, risk aversion, regulation, and now economic conflict resulting in some deglobalization or corrosion of globalization, all of those will keep the long rate down. And the R star, if you will, the unobserved equilibrium rate. And my colleague at Peterson Institute, Olivier Blanchard, argued for that. Gita Gopinath, Pierre-Olivier Gorin-Chas, and the IMF economists have argued for that. I have since become convinced, in part without irony, because Larry Summers has made, I think, a very strong case that there's a lot of fiscal upside coming, particularly in the US. There's a recent speech he gave at the Peterson Institute at a joint, as it happens, IMF-PIE conference last month, talking about the medium-term fiscal outlook for the US. And if you remember the arguments about secular stagnation that he started back in 2016, it was always said, well, and going back to Alvin Hansen's original secular stagnation in the 40s argument, big scale fiscal is what pulls you out, is what drives up the R-star. And so between green investment, defending Ukraine, so-called resilience measures, increased defense spending more generally, I think we're looking at sustained increases in fiscal policy and probably deficits, unfortunately. So to me, that's going to drive up R-star. Now, is it going to drive up R-star 0.75 or 1.25? Probably close to 0.75. Is it going to drive it up more in the UK than in the US or in Euro area? Probably.
How much more? Is it impossible to say?
I wouldn't say it's impossible to say, but I don't have a high deal of confidence in my guess. Anything in the 10 to 20 basis point range is meaningful when you're talking about long-term trend rates. Going back to something David was saying earlier, it's not fair to overinterpret every little gap, variation in the gap between US or European and UK rates on gilts, just as you can't overinterpret every day's movement in a given stock. But over time, I think we're going to see higher rates. Are not going to go all the way back down to what they were pre-COVID, and rates will settle at a slightly higher level in real terms in the UK than they will in Euro area in the US. And slightly higher means something, 10 or 20 pips, which over time on the real rate matters.
Adam, do you think that actually central banks could over tighten to make sure that, their credibility is at stake? So I don't know if the Bank of England right now, is really worried about that, if you think they've done enough to be credible, or whether they'll over tighten at all costs to make sure that actually they hit their inflation target. I
think you can, if you buy the kind of argument I'm making, you can make a case that the Bank of England has more need to quote unquote over tighten, or at least err on the side of being credible and significantly tighten, than the Euro area or the US, the Federal Reserve and the ECB need to. My whole point, though, is up till now, it's been the opposite. It's been every time the bank raises rates, a majority or the internals from the committee have said, well, that may be enough. And so, until they get up into 6.5 plus, and until they stop saying it may be enough before they get there, I think they have to do more.
Does the Bank of England still deserve its place at the top table amongst the central banks in the world? I mean, it's kind of there for perhaps legacy reasons. Is it time for a reevaluation of the status of the Bank of England?
Clearly, in terms of financial networks, financial stability, quality of the overall staff and the research, and influence, it's sort of a circular argument, but influence in central banking circles, in financial regulatory FSB discussions, in G7, G20 discussions, the Bank of England is at the top table. And you see this, I know Francine's just back from Sintra, right? So the closing panel, I think, at Sintra, or the big shots panel, was ECB, Fed, Bank of Japan, and Bank of England governor. And you often see the same constellation, plus or minus the People's Bank of China governor at Jackson Hole or other conferences as well. But I think it does have to be acknowledged that the Bank of England is essentially punching above its weight, given the developments in the UK. And this will be sustainable, just as the Swiss National Bank punching above its weight is sustainable. But it's got more and more then to do with the expertise of the Bank of England, the connectedness of the Bank of England, and less to do with the UK economy per se.
Adam, thank you so much. I feel all of my neurons in my brain working.
Well, it's summer, so thank you for having me anytime, but especially now.
Thanks for listening to this special bonus episode of In the City, and we will be back again later this week.
But in the meantime, if you like our show, please head on over to Apple Podcasts or wherever you listen to podcasts, rate, review, and subscribe.
This episode was hosted by me, David Merritt.
And me, Francine Lacqua.
It was produced by Summer Sadi, with help from Maria Al-Saraf.
Additional editing by Blake Maples.